Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined by Dave Ernsberger, the head of market reporting and trading solutions at S&P Global Commodity Insights, who looks amazingly well for the final day of APEC in Singapore. Dave, welcome.
Thank you, Sean. If I've learned anything in my many years of APEC and conferencing, it's pace yourself. So if I look okay, that's good news.
Yes. Well, it looks clearly like you did, and you stayed away from all of that plonky wine that gets served
Yeah,
across town all week.
that's for
Uh,
the kids. That's for the kids. Yeah,
yeah, exactly.
that's
We can't do that anymore. But
right.
listen, in terms of from a distance, it looked like a pretty serious gathering. Obviously, S&P Global hosting again for the 40th year the APEC conference, taking it from strength to strength. What were your main takeaways, if you would identify a top three, if that's allowed, from
Sure.
the what you you heard on your own stage, and then maybe we'll talk a bit of the wider circle of the gathering in Singapore?
Yeah, definitely. So, we're delighted to have 1,000 delegates at the conference itself, which is great news, from more than 50 countries. And it's not just a numbers game, Sean. You want quality of discussion, quality of content. But I like to think that if the discussion is good, that the attendance reflects that a little bit. Always does with GI events as well, of
Well,
course.
I think
But
it's really impressive that when you just from that point of articulation, that of course, as Platts has inherited APEC some years ago and has curated its journey back to being centrally
yes,
relevant
right.
in the
That's the goal.
thousands that are gathering in Singapore. And I think that's why the numbers maybe matter a little bit more in the sense of just a reflection of that achievement in recent years.
Well, thank you for saying that. We certainly put a lot of effort into trying to get that balance right. In terms of the top three topics that came out, for me, the number one topic was there was a kind of a pivotal moment here in Singapore this week, and the conversation that's going on in the market more broadly around the balance between supply and demand for oil. We began APEC with a sort of a survey of the audience to see where people felt Dubai would end 2024. And at the time, Dubai was trading at $73 a barrel. And the majority of the audience were thinking, in terms of the survey response, they thought Dubai would be back to 75 or 80 by December 31st. Now, in the 3 days that passed since then, the market's become decidedly more bearish than that. I think if we ran that poll again today, I suspect the outlook would be a little bit lower because number one conversation on stage was demand is growing slowly, supply is growing quickly. And this is a huge headache for the market, which kind of takes to point number two, which is what will OPEC plus do next in these markets? And that it's an associated point, but it's a specific one in its own right. The third topic I mentioned, Sean, is a bit of a different one. There in the background of all these conversations, and increasingly in some of the conversations you hear about in the bilateral meetings here, there's a keen interest in what's going to happen with next generation fuels. We came out of the pandemic with a rush to the head of excitement for hydrogen and ammonia, low carbon, no carbon, carbon markets for that matter. Here we are 4 years later, and a lot of those things are stuck in the mud. And what we were hearing a lot at APEC this year was, when will governments step in and provide some clarity about willingness to pay for these fuels and how they're going to make those things happen, which may or may not be fair. But I heard that for the first time this year since the pandemic, that actually government help is needed actually at this point.
In those surveys, as you are identified from your forum, the APEC conference, obviously the forum and the survey gives you the average, but you had some fairly big voices giving references to very bearish dollar numbers. I think it was the head of oil trading at Trafigura was identifying $60 or something to that effect, that some of the big sort of globally recognized traders were sound more bearish than the average.
Well, I think you're talking about Ben Lookock there, who gave a presentation along. We had others who spoke as well. We had Torbjorn speaking from Gunvor as well. I think that number 60 for Traffy might have been a little bit misreported by some of the media. My understanding, I was actually in the room when he was talking. I don't think he was predicting 60, but I do think he was making the point that markets are feeling kind of heavy at the moment, and whatever that number ends up being, right? There was a real difference of opinion between the mega bulls and the mildly bearish at this point, and there was a divergence of views. You know, we had Jeff Curry talking on stage at different points about his bullish outlook for oil prices. So there were a few bulls. But I would say notably, Sean, the people who were trading the physical barrels had a very bearish tone this year. So perhaps there's a difference between the view of those who are looking at futures markets and those who are looking at physical. And as you and I both know, physical at the end of the day, it does actually rule the outcome, really.
Well, one of the biggest voices you had, Russell Hardy, the CEO of Vitol, I think he made one reference, I mean, one of his comments amongst many, was his outlook for peak China gasoline demand. And of course, the demand for energy in China is one of the critical pillars that is underpinning any commodity market, and oil, of course. And to hear him articulate that peak gasoline, which of course is the mobility fuel and the biggest component of the consumption of oil, was, I think, quite a startling data point, a data reference from him. Where was China in all of the conversations you guys were hosting?
There was a lot of Chinese representation at APEC this year. I was hearing people telling me that a lot of folks from China might have had their own APEC the week before this, by the way. I don't know if that's true or not, but there were certainly plenty of representatives from the Chinese majors and a lot of the independents in Singapore this week. As I said, I think they might have been here last week too. So there was a lot of representation from China. But what I think people are learning is China is turning in front of our very eyes here. So for the last 15 years, China has been the engine of growth for the global oil market. And that's been particularly true for the last, let's call it 36 months, because China was first to collapse ahead of the pandemic, and it was the last to come out after the pandemic for various reasons. You know, they had an extended lockdown and everything else compared to some Western countries. So China was delivering outsized gains in demand as recently as 2023, and we got a big bump from jet in the first half of 2024. But those days are over. And Sean, the reason for that, and this is a bit of an epiphany for me, if nothing else, is this energy transition conversation circles around what people talk about as being the trilemma, right? Is a transition to a new fuel environment, is it underpinned by security of supply, sustainability of supply, and affordability of supply? And the eureka moment for me, and I don't think just me here at APEC this week, is China is moving now, because from a trilemma perspective, they can make it work. And most importantly, from a security of supply perspective, electrification of transportation is a security of supply question. It's a policy question that makes China move faster, not slower on that. That's wildly different to North America, South America, and Western Europe.
I mean, underpinning that energy security and that shift to electrification in China, of course, is coal. They are essentially, they may be peaking on oil and gasoline, but they're continuing to increase their investment in domestic coal and in import coal. They're not giving up coal.
That's right. So we shouldn't mistake the electrification of transportation in China as being a move to cleaner fuels, because a lot of it is coal-fired power generation. It's not a carbon question. It's a security of supply question, right? Having an electrified transportation takes your dependency on gasoline and diesel a little bit away. And this has been the shock to the oil market when you talk about demand, and whereas China's not showing up the way that it used to, because it doesn't have to. It's got other plans, and its plans don't involve oil the way they used to.
And was there any outlook or thought as to where OPEC, how OPEC Plus should read that? Of course, on the eve of your APEC conference, OPEC Plus announced their plans to abandon their increase in production that they were planning from October 1st. They've delayed that now 2 months, of course, as they watched the oil price drop below 70. They really probably had no choice. But where was their outlook in terms of what muscle does OPEC Plus still have in this current market, given all they've done in recent years?
Well, there's a feeling among speakers, delegates, folks I've been meeting with here in Singapore that OPEC is in a catch-22 situation. And look, it missed the window to increase production. We were talking about it at MPGC back in April that was the time maybe when OPEC could have done something, and it was too scary for OPEC to do it then. OPEC's just decided, as you say, OPEC Plus, to kick the can down the road on a relatively mild increase to December. But the question only gets louder and more insistent. If not now, then when? Because it's not going to get any easier in December, January, February, or March. It's just not going to get any easier. So, the theme of the conversation around OPEC Plus is, what is the trade-off between price on the one hand and unity on the other? Because OPEC, if it continues to defend price, is going to start fraying at the edges around unity. That's the issue.
Just sort of going a little bit wider into the APEC story, and as we now sort of close out the week, of course, there's thousands of people throughout the city and multiple different gatherings, all generally underpinned by the oil trading universe. I mean, there are many other actors there, of course, but that tends to be one of the big drivers, and they've had an unbelievable few years. They've more money, made more profit than most major companies of a much bigger size. But
Yeah.
that does feel like this year that's not happening. Was that part of the conversation? The party's over for the traders or not? Or how did that materialize in any of the chatter?
Well, the party didn't seem to be over, judging by the number of parties that were happening in Singapore. That's for sure. And I think we need to take a moment to reflect on why the traders have done so well, why the trading community has done so well. The flip side of having been so successful is they've taken on spectacular amounts of risk in the market. Like, the amount of risk involved to move LNG from Northeast Asia to Northwest Europe in 2022 is mind-boggling, right? So yes, by the way, I'm not here as an apologist for traders.
Of course, yeah.
I think when we see the profits traders have made, well, look, the market is compensating the traders for taking on all of that risk. And I would say, without the traders doing that, markets probably wouldn't have rebalanced as quickly as they did. But putting that all to one side, the parties might have been happening here in Singapore, but there's a feeling that the good times are over, because the ultimately the amount of volatility in the market, which speaks to dislocation in the market, and those dislocations are the opportunities for traders to take commodities where they are to where they're needed more. Well, that's all kind of gone away, and you struggle to find dislocation and volatility in 2024, like along the lines of what we saw in 2022 or 2023. Ultimately, that's good for the global economy, no doubt about it. Inflation is back under control, by and large, right? But it's not good for traders.
But they're still left with a bank balance full of cash. How they're deploying that? What does that look like? How is that changing the industry? You think we're seeing a lot of assets being acquired? Is there still a lot of road there?
Yeah, that's a really interesting question, Sean, and maybe it's something that'll come up when we all meet in Fujairah at the Gulf Intelligence event. There is, where will people, spend their money? Because the cost of trading has also come down, right? Flat prices are down, margin calls are down. There is a lot of wealth that's been created through the last couple of years, and where people have had success there. It's impossible to find more markets to trade in right now. There just aren't more markets to trade in. One of the frustrations about energy transition is, where is the hydrogen market? Where is the ammonia market? Where's the biobunkers market? Where's the SAF market, right? These are tiny markets for now. There'll be bigger markets in time, but they're not here in time for traders to put big bets down today. So I suspect asset acquisitions, M&A, things like that could be on the books for traders in the next couple of years, I would imagine. And in fact, it's interesting. We see companies coming together to launch new trading outfits, right? Bapco's moving into trading soon. It's happening around us. KPC is doing more. So maybe we'll see some of that money finding its way into new trading ventures as well.
How have the benchmarks worked, survived, and performed through this period of incredible volatility and incredible change of world oil flows? Obviously, Platts did restructure Brent in the last few years, and maybe an update on that as a starting point. And then I'd like to talk a little bit about Platts Dubai, of course, 40 years anniversary. But kicking off with Brent and its outcome and its journey over the last 2 years since you've changed its composition.
Yeah, that's a super important topic. And, one of the things that we focus, I would say, 80% of our time and effort on at APEC. You know, the other rest of it around organizing the conference itself. We spend 80% of our time and effort talking to the traders and the interested communities around how the benchmarks are doing. And, you know, Sean, we try and get ahead of what's needed in the market without being ridiculous about it. But we're always listening for what are the changes that are happening in the market? What does that tell us about evolution that might need to happen to the benchmarks so they can keep reflecting value in the market? And you're quite right. In 2022, we began to move full speed ahead with making big changes to Brent, specifically bringing Midland crude as a deliverable into Brent. And I'll say two things about that. Firstly, it's gone very well. Obviously, as a benchmark publisher, I would say that, so ask others for their opinion too. But the addition of Midland into Brent has certainly fortified the liquidity of the North Sea market. Having Midland as a deliverable on a CIF Rotterdam basis has helped Brent to stay reflective of light sweet crude economics throughout the entire period of volatility, from everything from post-pandemic to war in Ukraine to what we've seen in the last couple of years with reallocation of flows out of Russia. Brent has reflected the value that it's supposed to reflect. Now, the second thing I'll say about it is we're now in the detail phase of all of this, right? The post-implementation phase where people are looking for things to challenge, things to talk about. These could be the basis for what comes next in terms of the never-ending evolution of benchmarks. And one thing we get asked a lot of questions about is, well, how can it be that Midland is deliverable into Brent? And yet sometimes a trader and a buyer and a seller could agree to take it FOB Gulf Coast and maybe take it somewhere else. And that's a conversation we're having with the market right now. It's a welcome conversation. I could tell you, and this might be more detail than your listeners want to hear about, but it's only a very few cargoes that have ever been moved from being CIF Europe back to FOB Gulf Coast and gone somewhere else. But it's vital that that's there as an opportunity for people to agree mutually, because that's how the market trades, and it helps the European reference to stay balanced, that barrels can go elsewhere when they need to. Very much like how Forties goes to Korea sometimes. Now, I'm very aware that the last 2 minutes is more detailed than a lot of people want to hear, but I want to share it because A, it's something people are talking about here, and B, it tells you about the level of detail we're at. This is a million miles more advanced than where we were 2 years ago.
And just to sort of follow up on that, I mean, you mentioned the geographies. Obviously, Brent's big change was the inclusion of WTI, the US benchmark, into the basket. But now we're also seeing a lot of WTI, US crude moving into Asia. And I'm wondering how that complements the Brent price reference. And then what does that mean for the Platts Dubai, which is essentially the benchmark for the East of Suez market? How do those two things coexist?
Well, one of the reasons that we wanted to, in the end, move ahead with that plan to bring Midland as a deliverable into Brent was because so much of it was already flowing into Northwest Europe. It was before we brought it into Brent, and it still is today. Vast amounts of Midland are flowing into Asia as well, very much to your point. A lot of it will go into Northeast Asia, speculatively when the arbitrage opens up and it makes sense to do so. So Midland grade is really a baseload grade of crude oil for the global crude oil market, which is one reason why you'd want to see it reflected in the global crude oil benchmark that is Brent. Now, we've done similar things with Dubai, which celebrates its 48th year as a benchmark this year. You know, years ago, we moved, actually in 2016, to ensure there was enough crude oil deliverable against Dubai so that it could perform well in times of very active liquidity as well as in times of less liquidity. And I will tell you, Dubai has been more active in 2024 than in any other year. We've seen more trades of physical cargoes in the Platts assessment process. There's been more activity in Dubai derivatives than ever before. So on the one hand, on its 40th birthday, Dubai is in fantastic health. I wish I was doing so well at 40 as Dubai.
What explains that? I mean, what's the any specific reason?
Yeah, well, part of it is certainly the fact that so much more crude is moving around the Pacific market than it did 5 years ago, 10 years ago, and 20 years ago. You know, we talked about China's demand slowing down at the moment for certain refined products. But as we were saying earlier, China has been the engine of demand growth for oil for the past 5 and even 10 years. So the market is just that much bigger. And that's one of the biggest reasons why there's so much more liquidity in the Dubai reference price and the Dubai basket, just because the Asia market is bigger. In 2016, we saw buying out of China and even at times India that was way in excess of what people had expected to have. We've seen even bigger activity since 2016, but by bringing in that case, Murban and Al Shaheen as deliverables to the basket, helped make sure that Dubai was strong enough to withstand that kind of market activity, which is natural. I mean, the Pacific market is the biggest market if you include India and China together for crude oil anywhere in the world. It has to have the most deliverable benchmark underpinning the values out here.
If I might just wrap up, Dave, and getting your thoughts and Platts Analytics outlook as your collective research provides some insights into the future, your own crystal ball as to where we go from here through the rest of the year. Are you subscribing? Is your research indicating all of this bearishness you heard at APEC is warranted? I mean, you heard Mr. Curry at Carlyle Group being very bullish that the market was misrepresenting the fundamentals. What are you guys seeing? How do you see the rest of the year playing out?
Yeah, we don't see the fundamentals being misrepresented at the moment in the price. You know, our research team and our analyst team have forecasts around the $75 a barrel level, end of this year, end of next year, and we haven't moved too much off of that. I'll be curious to see if our researchers are revising their forecast now, just given how much new intelligence we've heard in Singapore this week alone. But we still see 75 as being the longer term value at the back of the projection period here, and the risk is to the downside. You know, there are many more. I mean, look, think of all the bullish things that we've seen happen that have barely gone noticed in the last couple of months, including OPEC's decision to defer production increases. And yet the price continues to look soft. So $75 a barrel has been our longer term outlook, and the risk remains to the downside.
Well, we'll have to wait and see how that goes, because it's certainly holding at the moment, not too far off that. We've got Brent in the low 70s. It sort of recovered, came back from that dip below 70. There was a 6 on the handle opening. Yes. I think it was Tuesday this week, the first and only day for, I think, a number of years maybe where that price has been present. And certainly I know for a lot of producers in our neighborhood here in the Gulf that they will hope to see at least a 7, if not more. Thank you, Dave Ernsberger, Head of Market Reporting and Trading Solutions at S&P Global Commodity Insights, for joining us on Halftime Talk.
Thank you, Sean.